All right, let's jump right into this. Imagine a company issues a bunch of new shares right smack in the middle of their financial year. At what exact moment do we start counting those specific shares for our earnings per share calculation? I mean, it sounds like a minor administrative detail, right? But in the world of corporate accounting, pinpointing that exact day is absolutely critical to presenting an accurate financial picture.
So, welcome to this explainer. Today, we're going to crack the code on how to calculate the weighted average number of outstanding shares. We're going straight to the accounting standards to figure out exactly how to handle this across 18 very specific corporate scenarios. So if you've ever found yourself a bit fuzzy on exactly when a share officially hits the books for weighting purposes, you are definitely in the right place. To make sense of this massive list without getting bogged down, we've organized things logically. We'll start with the basic timing of share weights, then cover cash and settlements, conversions, corporate actions and M&A, contingencies and treasury shares, and finally, we'll wrap up with the golden rule of resources. Let's get to it.
Okay, part 1, the timing of share weights. We need to lock down this foundational concept first.
Because a company's capital is practically always fluctuating throughout the year, calculating basic EPS requires a weighted average. We have to adjust the number of shares issued or bought back by a time-weighting factor. And that factor? It's simply the number of days those shares are actually outstanding as a proportion of the total days in the period. This means, quite literally, we desperately need to know the exact start date for every possible scenario just to get our numerator right.
Moving right along to part 2, cash, services, and settlements. This is our first major bucket, routine operations that bring in immediate value.
When you look at the raw NIS 33 guidelines, a really clear rule of thumb jumps out for this section. It's basically all about the exact moment the company formally recognizes the transaction in its financials.
For these straightforward transactions, the logic is actually incredibly clean. Think about it. Exchanging ordinary shares for cash, you count them from the date the cash is receivable. Issuing shares against services, count them when the service is actually rendered. What about settling a liability? The weight starts the exact day that settlement becomes effective. And if you're acquiring non-cash assets, the clock starts on the date that acquisition is officially recognized. It all just ties back to that immediate transfer of value.
All right, part 3, conversions and financials. Now things get slightly more complex here when we start turning debt into equity.
There is a really fascinating contrast to watch out for here. When a company issues ordinary shares against the conversion of a debt instrument, or, say, against the interest or principal of any financial instrument, the shares are weighted from the date when interest ceases to accrue. Makes sense, right? The debt stops, the equity begins. But for mandatorily convertible instruments, they are included from the very day the contract is entered into. The absolute certainty of that mandatory conversion shifts the entire timeline forward. Now, what if we're dealing with partly paid-up ordinary shares? Well, you kind of throw a specific calendar date out the window. Instead, we use a math ratio. You take those ordinary shares and weight them in the ratio of the amount paid up to the total face value of the share.
Okay, part 4, corporate actions and M&A. Let's see how this whole framework handles major structural changes to a company.
Do you notice a pattern with these events? For bonus shares, share splits, and reverse splits, specifically consolidations without a reduction in resources, you always backdate the weight to the beginning of the reporting period. And the reason why is pretty simple. You haven't actually brought any new capital into the business. You've really just sliced the existing pie into different sized pieces.
But definitely pay close attention to this vital exception. Like we just said, a standard reverse split is backdated. However, if a reverse share split involves a consolidation with a reduction in resources combined with a special dividend, the date shifts dramatically. In that highly specific scenario, the shares are weighted from the exact date the special dividend is recognized. We see that exact same split in logic when dealing with equity shares issued as consideration in a business combination. If it's a common control business combination, boom, the shares are included in the weighted average from the beginning of the reporting period. But if it's a standard acquisition, those shares only count from the strict date of the acquisition itself.
Oh, and just a quick note before we move on. If the company initiates a rights issue, the shares aren't just time-weighted on a calendar. They actually have to be mathematically adjusted using a specific rights factor. This just makes sure we account for the bonus element inherent in a rights issue, giving us an accurate EPS.
Moving to part 5, contingencies and treasury shares. Basically, how we manage uncertainty.
When you're managing uncertainty, timing really is everything. Contingently issuable shares only start counting from the date when all necessary conditions are satisfied, meaning, the triggering event has actually occurred. On the flip side, contingently refundable shares will only be included in the weighted average from the exact time they are no longer subject to recall. And finally, if a company purchases treasury shares for cash, which obviously reduces outstanding shares, that reduction is time-weighted immediately from the date of purchase.
Which brings us to part 6. Honestly, this is the most important takeaway of the whole explainer, the golden rule of resources. We've thrown a lot of scenarios at you, so how do you remember all this without just painfully memorizing it?
It all boils down to this really brilliant underlying logic from the accounting notes. Listen to this. The weighted average number of ordinary shares outstanding shall be adjusted for events that have changed the number of ordinary shares outstanding without a corresponding change in resources. Essentially, if an event changes the share count but doesn't change the actual resources or capital of the company, like a bonus issue or a simple stock split, we just adjust the weights back to the beginning of the period. But if real cash, real assets, or actual services change hands, we start the clock on the date of that specific transaction. It's that simple.
By mastering this resource-driven framework, you don't just know the rules, you actually understand the why behind them. So I want to leave you with this thought. If a company you're analyzing announces a massive, highly complex restructure tomorrow, will you be able to pinpoint exactly when those share weights shift?
Let's be honest, it often gets buried under a mountain of dense accounting jargon. We are demystifying the rules behind diluted earnings per share, or diluted EPS. If you've ever glanced at a company's financial statements, you've definitely seen this metric sitting right next to basic EPS, but understanding exactly how it's calculated, and more importantly, why it matters, is absolutely crucial for getting a true picture of a company's value. So in this explainer, we're going to unpack these accounting rules step by step and turn some pretty complex formulas into crystal clear concepts.
Okay, here's our roadmap for today. First, we'll look beyond basic EPS, then break down the diluted EPS formula by adjusting both the numerator and the denominator. After that, we'll uncover the critical difference between dilutive and anti-dilutive shares, and finally, we'll walk through the strict sequence of dilution. Let's jump in.
Section 1. Beyond basic EPS. So you can kind of think of basic EPS like a pizza party. It measures your slice based only on the people currently sitting at the table. It takes the profit attributable to ordinary equity holders and just divides it by the weighted average number of ordinary shares currently outstanding. But we've got to ask ourselves, is basic EPS actually telling the whole truth? I mean, what happens when there are people standing out in the hallway, holding tickets that guarantee them a seat and a slice of that exact same pizza in the near future? If you're only looking at the folks currently sitting down, your slice looks a whole lot bigger than it actually is, right? Basic EPS completely ignores those people in the hallway.
Now those tickets held by the folks in the hallway, that's what accountants call a potential ordinary share. Basically, it's a financial instrument or contract that might entitle its holder to ordinary shares down the line. In the real corporate world, these tickets take the form of things like convertible debentures, convertible preference shares, stock options, or warrants. They aren't shares today, sure, but they could absolutely become shares tomorrow. And when they do, well, that corporate pie gets sliced into much thinner pieces.
Section 2. The diluted EPS formula.
So to calculate diluted EPS and account for those potential shares, we actually have to alter both the top and bottom halves of our standard equation. We can't just bump up the share count, we also have to adjust the profit. For the numerator, the top half, we use the profit or loss attributable to ordinary shareholders. But crucially, this is after making specific adjustments for diluted earnings. Then, for the denominator on the bottom, we take our existing weighted average number of ordinary shares and add all the shares that would exist, assuming those potential shares were actually converted.
Section 3. Adjusting the numerator. Now, you might be wondering, why on earth do we need to adjust the profit if we're just issuing new shares? Well, think about it. If we're pretending that those potential shares, like say convertible debentures, have already been converted into regular equity, we also have to pretend that the company no longer has to pay the costs associated with them. So there are 3 specific after-tax effects we have to adjust for. First, any dividends related to these potential shares that were previously deducted, those get added back. Second, any interest recognized in the period for things like convertible debt also gets added back. Makes sense, right? If the debt is now stock, you aren't paying interest on it anymore. And third, we adjust for any other changes in income or expense that would result from that conversion. But notice the key phrase here,
after-tax effect. Since our starting net profit is already after tax, any interest or dividends we add back must also be calculated net of tax, just to keep everything consistent.
Section 4. Adjusting the denominator.
All right, so now that we've adjusted our profit pool on top, let's shift our focus to the bottom half of the formula, updating the share count. This part is conceptually pretty straightforward, even if it's mathematically rigorous. We're essentially just pretending these potential shares have already become real, actual shares. We take our base weighted average number of ordinary shares, and we add the weighted average number of ordinary shares that would be issued on the conversion of all dilutive potential ordinary shares. And get this, it even includes potential shares issued by a subsidiary, joint venture, or associate, assuming they have a dilutive effect on the basic earnings per share of the parent reporting entity.
But wait, there's a very strict accounting rule regarding the exact timing of this assumed conversion. We can't just pick any random date that suits us. The rules actually dictate that these potential shares are deemed to have been converted at the very beginning of the reporting period. The one and only exception is if the potential shares were actually issued later in that exact same period. In that case, we assume conversion from the date of issue. This strict rule ensures the weighted average calculation perfectly reflects the absolute maximum time those potential shares could have impacted the company during the year.
Section 5. Dilutive versus anti-dilutive. Okay, now we reach the major plot twist of this whole process. Up until now, it kind of sounds like we just convert everything and call it a day, right? But accountants actually draw a really sharp line between what is dilutive and what is anti-dilutive. Remember, the entire point of diluted earnings per share is to show investors a conservative worst-case scenario. Because of that, a potential share is only considered dilutive if its conversion actually decreases the earnings per share or increases the loss per share. Those ones, we include them. But, and this is a big but, if converting a potential share would actually make the EPS look better, meaning it somehow increases earnings per share or decreases a loss, it gets labeled anti-dilutive. And the golden rule here? The calculation of diluted earnings per share completely 100% ignores anti-dilutive potential shares, no exceptions. We simply do not assume conversion if it makes the numbers look better.
Section 6. The sequence of dilution.
Which brings us to the climax of this explainer. What happens when a corporation has a whole bunch of different types of potential shares floating around? Maybe they've got employee stock options, a series of convertible preferred stock, and some convertible debentures all at the exact same time. Well, the overarching rule is to maximize the dilution of basic earnings per share. To find the absolute maximum level of dilution possible, accountants are required to consider each issue or series of potential ordinary shares entirely separately, rather than just clumping them all together in one big aggregate pile. And the actual sequence in which you consider them, that heavily affects whether they end up being deemed dilutive or anti-dilutive.
So, let's see how this builds step by step into a really strict hierarchy. First in line, always options and warrants. Why's that? Well, as the rules note, it's because they generally do not affect the numerator of the calculation at all. They literally just add shares, which makes them purely dilutive right out of the gate. After those are factored in, we rank all the remaining instruments by their earnings per incremental share. We absolutely must include the most dilutive potential shares first, meaning those with the lowest earnings per incremental share, before we can move on to the ones with a higher earnings per incremental share. We just keep adding them into the calculation one by one, stopping at the exact moment the next instrument becomes anti-dilutive. This meticulous, step-by-step sequence is what guarantees we find the absolute lowest possible EPS figure.
Which leaves us with this final thought. Next time you're looking at a company's financial report and you see that diluted EPS figure sitting right below the basic EPS, you now know exactly what it represents. It's not just some rough guess. It is a meticulously calculated, highly regulated metric designed to show you the ultimate worst-case scenario for your specific slice of the corporate pie, assuming every single viable financial instrument was converted into shares. It essentially forces companies to be completely transparent about their true equity structure. So the next time you're evaluating a stock and celebrating a massive earnings beat, maybe pause and ask yourself, who else is holding a ticket in the hallway, just waiting to claim a slice of your pie?
Today, we're jumping straight into one of the absolute best stress tests in the financial world. We are looking at the metric accountants use to show us the absolute worst-case scenario for a company's true value per share. Yep, we're talking about diluted earnings per share, or diluted EPS. It is essentially the ultimate what-if game played by corporate accountants, and honestly, understanding exactly how they play it is absolutely crucial for anyone trying to figure out what a company is actually worth.
Okay, let's dive into this. Think about it like this. Imagine a company's total earnings are a freshly brewed pot of coffee, right? And the shares you own represent your own individual cup. Now, what happens if someone suddenly dumps a whole pitcher of hot water into that coffee pot? The total amount of coffee hasn't actually changed, but your individual cup, your specific slice of the pie, just got way weaker. That is dilution. So the question we're asking is, are a company's basic earnings telling you the whole truth, or are there hidden potential shares waiting in the wings to completely water down your investment? So here's our roadmap for today. We're going to hit the delusion illusion, options and warrants, contingent shares, cash versus share settlements, and wrap up with purchased versus written options.
All right, part 1, the dilution illusion and how it reduces EPS.
So dilution is formally defined as a reduction in earnings per share. But the absolute key word here is assumption. It happens when accountants assume that all those convertible instruments actually get converted, that all options and warrants are exercised, and that all conditional shares are issued. This isn't necessarily what has happened, it's what could happen. It's basically a financial fire drill designed to prevent nasty surprises for us down the road.
And this slide really highlights the contrast. Basic EPS, that's your current reality. It's based only on the weighted average ordinary shares that are currently outstanding. Diluted EPS is your worst-case scenario. It includes all potential ordinary shares that could decrease earnings. But keep in mind, it only includes them if they decrease earnings. If these potential shares would somehow increase earnings per share, they're called anti-dilutive, and accountants just completely ignore them for this calculation. We literally only care about the bad news here.
Moving on to Section 2, options and warrants, those little sweeteners for investors.
So options and warrants give the holder the right to purchase ordinary shares. They're often used as sweeteners attached to other securities to make them more attractive. But remember, for the purpose of calculating diluted EPS, the entity has to assume the exercise of these dilutive options and warrants. If those holders pull the trigger and buy, it increases the total number of shares, which dilutes the existing shareholders.
Now, what's really interesting about this is the tricky math they use. The accountants assume the proceeds from these instruments are received from issuing ordinary shares at the average market price. But here is the catch. The difference between the number of ordinary shares actually issued and the number of shares that would have been issued at the average market price is treated as an issue of shares for absolutely no consideration. Zero. Basically, free shares. And it's these free shares that really drive the dilution.
But they aren't always dilutive. Options and warrants are dilutive only when they would result in issuing shares for less than the average market price during that specific period. Think about it. If the option price is higher than the average market price, no one in the right mind would exercise it, right? So accountants only care about these instruments if they're actually dragging that average price down.
All right, Section 3, contingent shares, promises based on future events.
Contingently issuable shares are basically if-then scenarios. And the rules here are super strict. If the conditions are satisfied, boom, they're treated as outstanding and included in diluted EPS. And they are included from the very beginning of the period, or from the date of the agreement if that's later. But what if the conditions aren't met yet? Well, the accountants calculate it based on the number of shares that would be issuable if the end of the reporting period was the end of the contingency period. They're basically asking, if the deadline was today, would you get the shares? Which brings us to this incredible rule. Restatement is not permitted if the conditions are not met when the contingency period expires. This is wild. If the accountants assumed the worst-case scenario and booked the dilution, but then the future condition fails and those shares are never actually issued, they don't go back and rewrite history. Restatement is not permitted. That worst-case snapshot just permanently stays in the books for that period.
Section 4. Cash versus share-settled contracts, assuming the absolute worst.
Check this out. When an entity issues a contract that can be settled in ordinary shares or cash at the entity's option, the rules state the entity must presume it will be settled in ordinary shares, and those potential shares have to be included in diluted EPS if the effect is dilutive. Accountants are basically playing the ultimate pessimist here. They are always going to assume you're issuing shares because it creates the worst case, most dilutive outcome.
Finally, Section 5, purchased versus written options.
So the crucial point here is whose hands the options are actually in. Purchased options, like purchase put or call options held by the entity on its own shares, are not included in diluted EPS. Why? Because including them would be anti-dilutive. It would make things look better, and we toss out good news in this stress test. On the other hand, we have written put options. These are contracts requiring the entity to repurchase its own shares. These absolutely are included if they're dilutive, specifically if they are in the money during the period, meaning the exercise or settlement price is above the average market price.
Okay, let's slow down for a second. Because the math on these in-the-money written put options is fascinating. It's a three-step logic. First, they assume that at the beginning of the period, sufficient ordinary shares will be issued at the average market price just to raise the proceeds to satisfy the contract. Second, they assume those proceeds are actually used to satisfy the contract, to buy back the shares. Third, they look at the incremental ordinary shares. That's the difference between the shares they assumed were issued and the shares they received back. That incremental difference is what gets included in the diluted EPS calculation. It is a crazy intricate way to simulate the exact drag on shareholder value.
Which brings us to our final thought. Diluted EPS is a total masterclass in accounting prudence, right? From ignoring anti-dilutive purchased options, to treating warrants as issuing shares for no consideration, to forcing the assumption of share settlements over cash, it's all meticulously designed to show the absolute worst-case scenario. It makes sure you know exactly how weak your cup of coffee could get. But as an investor, it really leaves you with a profound question. If diluted EPS is built entirely on assuming the worst, is that worst-case scenario the actual truth of a company's value, or is it just a really well-calculated financial ghost story? I'll let you ponder that one next time you're digging into a financial statement.